Imagine waking up tomorrow and seeing gold explode above 5,300 or suddenly crash below 5,100. One clean break could decide the next major move, and most traders will either catch the wave or get completely trapped. In today's video, I'm going to walk you through the exact price levels that smart traders are watching right now, and how you can position yourself before the big move happens. Because in this market, it's not about guessing. It's about reacting to levels. Speaks. If you're new here, welcome to Forex Trading Rocket Signal, where we break down the market in a simple, practical way that actually makes sense. And before we go deeper, take 2 seconds right now, tap the like button, and subscribe to the channel. It really helps the channel grow, and it tells me you want more clear, no-hype gold analysis like this. Let's talk about what really matters. Right now, the key resistance zone in gold sits between 5,200 and 5,300 V. This is not just a random area on the chart. This is where sellers previously stepped in. This is where momentum slowed down. And this is where traders who bought lower may start taking profit. When price approaches resistance, it's like walking into a ceiling. Sometimes it breaks through powerfully. Other times, it gets rejected hard. Now, here's where it gets interesting. If gold manages to close a full daily candle above 5,300, that's not just a small move. That's a statement. A daily close above 5,300 tells us buyers are strong enough to absorb selling pressure. It signals that momentum could continue higher. That kind of close often brings in breakout traders, momentum traders, and even institutions that were waiting for confirmation. And when that liquidity enters the market, we can see acceleration. But until that happens, resistance is still resistance. Many traders make the mistake of buying directly into resistance without confirmation. That's risky. Instead, smart traders wait for proof. Either a strong breakout and close above 5,300, or a clear rejection that offers a short opportunity back down. On the other side of the market, we have the support zone between 5,100 and 5,150. Think of support as the floor. This is the area where buyers previously defended the price. It's where demand stepped in. When price falls into support, we watch carefully. Does it slow down? Do we see smaller candles? Do we see bullish reactions? If yes, that tells us buyers are still active. If support holds between 5,100 and 5,150, we may see another upward move. That bounce could push price back toward 5,200 and possibly retest 5,300 again. This creates a range environment where price moves between support and resistance. And ranges can be very profitable if you understand them. You buy near support with confirmation. You take profit near resistance. You stay patient in the middle. Bet. Here's the scenario you really need to respect. If gold breaks below 5,100 with strong momentum, especially if we see a daily close below that level, that becomes a bearish signal. That tells us the floor is no longer holding. And when a floor breaks, it often turns into a ceiling. Sellers gain confidence. Buyers who entered at support may start closing positions. That adds more selling pressure. And that's how corrections accelerate. A break below 5,100 does not mean the long-term trend is over. It simply means we could see deeper correction before the next bullish phase. Markets move in waves. Impulse, correction. Impulse, correction. The key is not to emotionally react. The key is to read the structure. Let's slow this down and imagine 2 possible paths. First scenario, price dips into 5,120. It forms strong bullish candles. Wicks reject lower prices. Volume increases slightly. The market refuses to stay below support. That's a clue. That's buyers stepping in. From there, price starts climbing back above 5,180, then 5,200. And now traders are watching 5,300 again. If momentum builds and we finally get that daily close above 5,300, the breakout traders jump in and fuel the rally. Second scenario, price approaches 5,120 again. But this time there is no strong reaction. Candles close near their lows. Momentum feels heavy. Then suddenly we get a strong bearish candle that closes at 5,080. That's the break. That's the shift. That tells us the structure has changed. In that case, traders start looking for pullbacks to sell rather than dips to buy. This is why levels matter so much. They give you a map. Without levels, trading feels emotional. With levels, you have a plan. You're not guessing where price might turn. You're waiting for price to reach key zones, and then you react. Another important point is patience. Many traders lose money not because they don't know the levels, but because they can't wait. They enter in the middle of the range. They chase candles. They panic during small pullback. But the highest probability trades usually happen at extremes, near strong support or strong resistance, or after confirmed breakouts. Also remember that daily closes are more powerful than intraday spikes. Price can spike above 5,300 for a few minutes and then fall back down. That is not confirmation. We want to see a solid daily close. That shows commitment from larger players. The same rule applies to breaks below 5,100. Wicks can fake you out. Closes tell the real story. Risk management is everything here. Even if you believe gold will break higher, you never risk too much on one idea. Because markets can surprise anyone. Keep position sizes controlled. Place logical stop losses. Protect your capital first. Profits come second. Now let's talk about psychology for a moment. When price is near 5,300, social media gets loud. People start shouting new highs coming. When price drops near 5,100, fear spreads quickly. Headlines turn negative, but as traders, we don't trade emotions. We trade reactions at levels. The chart is our truth. If you've been watching gold for a while, you already know how explosive it can be once it picks a direction. That's why preparation matters. You don't wait for the move to happen and then panic. You plan both scenarios in advance. If it breaks above 5,300 and closes strong, you look for bullish continuation setups. If it breaks below 5,100 and confirms, you shift bias and look for bearish opportunities. Between 5,150 and 5,200 is more of a neutral zone. That's the middle. And the middle is where many traders get chopped. So be selective. Let the market come to your zones. Patience is a position too. At Forex Trading Rocket Signal, our goal is not to predict every candle. It's to prepare for high probability moves. And right now, the battlefield is clearly defined. Resistance at 5,200 to 5,300. Support at 5,100 to 5,150. Break above 5,300 with a daily close signals bullish strength. Break below 5,100 signals potential deeper correction. As we move into the next sessions, watch how price behaves when it approaches these zones. Does momentum increase? Does volume expand? Do candles close strong or weak? These small details tell a bigger story. And here's something powerful. Sometimes the best trade is no trade. If price is stuck in the middle with no clear direction, it's okay to wait. Capital preserved is capital ready for the next opportunity. 2. We are not here to gamble. We are here to execute with discipline. That's the difference between random trading and professional trading. Before we wrap up, I want you to think about this. Which scenario do you believe is more likely? A breakout above 5,300 and continuation higher? Or a breakdown below 5,100 and a deeper pullback? Drop your opinion in the comments. I read them and I love seeing how different traders view the market. Your perspective might even help someone else think differently. This breakdown helped you understand gold levels more clearly. Make sure you like this video and share it with another trader who needs structure instead of noise. And if you haven't subscribed yet to Forex Trading Rocket Signal, do it now so you don't miss the next gold update when the breakout finally happens. Stay patient, stay disciplined, and remember, the market rewards preparation, not prediction. I'll see you in the next one.